Okay, let's dive into this. Welcome to The Explainer. If you've ever traded options, or honestly, even just glanced at the markets recently, you know volatility is pretty much the name of the game, right? But you hear these terms, HV, RV, IV, tossed around like alphabet soup, and it leaves a lot of us just completely lost. Well, today, we're going to demystify these core concepts. We're breaking down exactly what they mean, and more importantly, how they literally dictate your survival in the market.
To kick things off, I want you to ask yourself a very specific question. What actually happens when market volatility exceeds our expectations? Think about that for a second. We all have this natural instinct to avoid risk. We like things to go according to plan. But in the financial markets, when the reality of price movement shatters what we thought was going to happen, man, chaos ensues. And teasing the answer to this right now, it's the absolute key to understanding why short sellers get trapped and completely wiped out so often.
To get to that answer, here's our game plan for today. First, historical volatility. Then, realized volatility, which is today's action. Third, implied volatility, or future expectations. 4, Black-Scholes and the complex math. 5, the IV versus RV spread. And finally, number 6, the impact on short sellers.
So let's jump right into part 1, historical volatility, or HV. To understand where we're going, we first have to look backwards.
Now, what's really interesting here is that historical volatility is purely 100% based on analyzing the past. Think of it kind of like looking at a weather report of actual rainfall over the last 10 or 30 days. It doesn't tell you if it's going to rain tomorrow. It's simply a calculation of the fluctuations that have already happened. We take a specific look-back period, gather the hard data, and measure just how much the price jumped around during that window. And actually, the process to figure this out is incredibly straightforward. You could literally do this yourself. You just gather your 10 or 30 days of daily returns data, paste it right into an Excel spreadsheet, and apply a super simple standard deviation formula. Specifically, it's the stdev.p function. Imagine over 10 days, daily rainfall varied from 1 millimeter up to 10 millimeters. Plug those numbers into Excel, and the formula outputs your historical fluctuation. Let's say it's around 2.87. That number right there, that's your historical volatility. It tells you the average deviation from the norm based strictly on past factual data. Moving our timeline from the past into the immediate present, we hit part 2, realized volatility, which is all about today's action.
Realized volatility, or RV, is the actual price movement happening right now. It drops that long 10-day or 30-day look-back period and focuses strictly on the immediate change. You calculate it just by looking at yesterday's close versus today's current price. So, if a stock was sitting at 100 yesterday and it jumps to 105 today, RV is capturing that exact immediate reality in percentage terms. It's the action happening literally right before your eyes.
Now, for the most crucial metric for options traders, part 3, implied volatility, or future expectations. We're looking forward into the unknown.
Implied volatility, or IV, is entirely forward-looking. If HV is the past rainfall and RV is the rain hitting your roof today, IV is the weather forecast estimating tomorrow's rainfall probability. It measures what the market expects the price movement to be in the future, usually leading up to an expiration date. But here's the kicker. It's derived backward from the current prices of call and put options. You see, the market is constantly pricing in fear, greed, and expectations. IV essentially extracts that expected future volatility directly from those option premiums.
Which brings us to part 4, Black-Scholes and complex math. And yeah, we have to acknowledge the elephant in the room here.
The math behind calculating implied volatility can seem, frankly, terrifying for most of us. The Black-Scholes formula requires heavy 12th grade level calculus just to reverse engineer option prices. You've got to take the fluctuating prices of calls and puts, plug them into this massive complex equation, and work backward just to spit out the implied volatility percentage. If you don't understand advanced calculus, it can feel like a totally impenetrable wall.
But hey, take a deep breath, all right? Because I want you to remember this quote. Focus on the outcome, not the formula. You absolutely do not need to memorize advanced calculus to be a highly successful options trader. There are kids out there successfully trading options today who haven't even taken a calculus class yet. The software does all the heavy lifting for you. What actually matters is that you understand what the number represents and how to use it strategically. You don't need to know how to calculate it by hand on a chalkboard.
And this brilliantly illustrates the core difference we've discussed so far. On one side, you've got historical volatility. It's backward-looking, it analyzes past data, and it uses simple Excel math. On the flip side, you have implied volatility. forward-looking, estimating future movements, and built on complex Black-Scholes calculus. It is the clear contrast between where the market has been and where it expects to go.
Let's move to part 5, the IV versus RV spread. This is the core analytical concept where expectations finally meet reality.
Let's lean back into our rainfall analogy to really grasp the spread. We're basically comparing what was expected to happen, that's our implied volatility, against what actually happened, our realized volatility. Just think about the scenarios. In the first one, you expect 100 millimeters of rain, and the actual rain comes in at 95. The difference is positive. But in the second scenario, you expect 100 millimeters and you get hit with 105. The result is negative. Just like the tragic, unexpected floods in places like Nanded or Kolhapur, when actual conditions severely exceed expectations, destruction follows.
So when your implied volatility is 100 and your realized volatility comes in at 95, you subtract RV from IV and get a spread of positive 5. This is your safe zone. You expected a certain amount of movement, you got slightly less movement than you planned for, and everything is perfectly fine. The dam holds, no panic.
But when your implied volatility is 100 and your realized volatility spikes to 105, your spread drops to a -5. This negative spread, it represents unexpected chaos. It's kind of like opening a Vodafone or Airtel bill, expecting a routine 300 rupee charge, and bam, you see a 500 rupee charge instead. That sudden shock hurts. And in the financial markets, this exact mathematical shock dictates whether you make money or lose your shirt.
That leads us perfectly into part 6, the impact on short sellers. How does this exact spread dictate survival?
Look, anything exceeding expectations in life and especially in finance is incredibly dangerous. Imagine planning and catering a wedding for 1,000 guests and 5,000 people show up. Absolute disaster, right? Or imagine engineering a house to withstand a 7.0 magnitude earthquake and getting hit by something far stronger. The whole structure collapses. When market movements exceed expected parameters, the financial structures that traders build, especially those built by short sellers, begin to collapse.
And this brings us to the foundational rule. Short sellers absolutely, desperately need realized volatility to be less than implied volatility, period. If they expected a 20% annualized volatility, they want the actual market reality to come in at 15%. They need the actual day-to-day movement of the market to be quieter, calmer, and smaller than the forecast.
So, the crucial point is what happens when the opposite occurs, when realized volatility is greater than implied volatility. When the actual movement blows past the expectation, it is an absolute disaster. Short sellers get trapped in their positions. Stop losses get aggressively triggered, which just fuels further market spikes. Carefully constructed hedging strategies completely blow up. And maybe most importantly, the reliable engine of options selling, theta decay or time decay, slows down drastically or just completely stops benefiting the seller.
Because to make money from theta decay, you really need peace and quiet. When RV is less than IV, the market is calm and theta decay works beautifully in your favor as a short seller, slowly eroding the options value and putting money in your pocket. But the moment RV spikes higher than IV, you lose that benefit entirely. The violent price swings just completely overwhelm the slow drip of time decay, and the short seller faces massive, rapid losses.
So I'll leave you with this final, thought-provoking question. As you navigate the markets, are you wasting your energy trying to master the complex calculus of the Black-Scholes formula, or are you focused on the dynamic that actually matters? Surviving the outcome by understanding the crucial spread between expectation and reality. Surviving the market isn't about doing math on a whiteboard, it's about ensuring your exposure to realized volatility never exceeds your implied volatility threshold. Keep your RV below your IV and let the market work for you. Thanks for joining me on this explainer, and I will see you next time.